You can keep working for another 30 years. Or, in the next 20 minutes, figure out exactly how much you actually need to exit the game. And if you believe in retiring at 40 without significant capital, you've already been sold. And at a very high price. Attention! If you miss one crucial detail about passive income right now, you can forget about financial independence for the next several years. Almost every American has asked themselves at least once in their life, how much money do I need in the bank so that one day I can wake up and realize I don't have to work anymore? Not just scrape by on the bare minimum, but truly live, travel, focus on what you love, and not stress over a monthly bank statement. The internet sells this idea every single day. Blogs, YouTube videos, ads from so-called gurus, all promising passive income, financial freedom, and retirement at 40. But behind those flashy headlines, there's often nothing more than a money grab, or worse, dangerous financial advice that can wipe out your savings. Today, we're not going to sell you another magic pill. We're going to break it down step by step. Instead of vague dreams, you'll get a clear, practical formula. With this formula, anyone can calculate their personal freedom number, the exact amount of capital that would allow you to stop working for a paycheck and start living off returns. But that's not all. We'll go even further and walk through two completely different paths to reaching that number. The first path is long, conservative, and almost stress-free. It's perfect for those who don't like taking risks and are willing to play the long game. The second is fast, aggressive, and, let's be honest, not for the faint of heart. It can get you there much sooner, but the cost of a mistake is much higher. The choice, as always, is yours. Let's get started. The first thing you need to clearly understand is this. Can you realistically count on retiring early and living off your capital? In the US, online space, especially on YouTube and social media, we're constantly being fed the same idea. Quit the job you hate, stop working for the man, work for yourself, live off passive income. This is one of the biggest myths of our time, and it has cost many Americans their savings and their peace of mind. The concept of passive income is almost cynical in its simplicity. Someone else has to work for you while the money flows in your direction. Ask yourself an honest question. Are there really that many people eager to work for you while you relax on a beach? Obviously not. The vast majority of people want to work for themselves, not for someone else. And when everyone wants to be their own boss, the whole passive income story becomes nearly impossible to pull off. In reality, most people who sincerely believe they live on passive income are actually self-employed. They're just afraid to admit it to themselves. They work more than ever, only now it's not for a corporation, but for their own business. And that's not passive income. That's active work with a different label on it. Take the classic American example, investing in rental real estate. It sounds perfect. Buy a house or a condo, rent it out, and live off the rental checks. But there's one major problem. Very few people own enough properties to live comfortably off just one. In the US, you're realistically talking about at least 3 to 5 properties to generate a solid, reliable cash flow. And anyone who has ever owned rental property knows what comes with it. Tenants move in and out. Things constantly break. Pipes leak. Neighbors complain. You get a late-night call because a toilet is clogged. The more of these passive properties you own, the more headaches you take on. Yes, the cash flow is real, but you're solving problems every single day. That's not passive income. That's a job. And it doesn't free you from stress or responsibility. And here's the main rule you should remember once and for all. Without capital, you will have neither passive nor active income, period. Without savings, all the talk about financial independence is just empty noise. So, you've built up capital. Congratulations! But are you ready for the next problem? It's called inflation, and in American reality, it's the most deceptive enemy of financial independence. Picture the perfect scenario. You retire early, you've got a solid bank balance and an investment portfolio earning, say, 8% a year. You decide to spend that full 8% on living expenses, travel, and enjoying life. And that's the fatal mistake millions of Americans make. Why? Because official U.S. inflation, the numbers published by the Bureau of Labor Statistics, usually sits around 2 to 3%. But that's just an average on paper. It factors in cheaper TVs and imported clothing, but it doesn't reflect your real day-to-day expenses. Unless you're living like a college student surviving on instant noodles and renting a dorm room, your personal inflation rate is likely much higher. Healthcare, dental care, insurance, especially health insurance, rent in major cities, education for your kids, gas, all of it tends to rise much faster than the official rate. In reality, for America's middle class, personal inflation often runs closer to 5 to 6% a year, sometimes more. And this is where the real trap lies. A portion of your investment return is simply offsetting rising prices. If your portfolio earns 8%, but your personal inflation rate is 5%, then your true spendable return, without touching your principal, is only 3%. The other 5% needs to stay invested just to preserve your purchasing power. If you ignore this rule and spend the full 8%, the consequences will show up in 10 to 15 years. Your capital will start to erode. You could still have $1 million in the account, but it won't buy what it did a decade earlier. Inflation works quietly, but relentlessly. It steals your future while you're not paying attention. That's why the first rule of financial freedom is this: don't just calculate portfolio returns, calculate returns above inflation. Only then can you preserve your capital and pass it on to the next generation. Now that we've broken down the hidden impact of inflation, it's time to move on to the most important part: calculating your freedom number. This is the amount of money that needs to work for you and support your desired lifestyle indefinitely, without being depleted. In the world of financial planning, this is known as your FIRE number. Financial independence, retire early. In the US, there's a simple but highly effective formula that financial advisors, and even millionaires who retired before 40, rely on. It's based on what's called the safe withdrawal rate. The idea is straightforward. You withdraw a certain percentage from your investment portfolio each year, and your money should last 30 years or more. The classic 4% rule, based on the Trinity study, says that if you invest in a balanced portfolio of stocks and bonds, for example, 60% in the S&P 500 and 40% in bonds, you can safely withdraw 4% of your initial portfolio annually, adjusted for inflation. But that rule was designed for a 30-year retirement. If you're planning to live off your capital longer, and you probably are, it's smarter to lean toward a more conservative 3.5% or use dynamic withdrawal strategies. However, we'll take a slightly different approach and focus on returns above inflation. Historically, the S&P 500 has delivered average annual returns of about 10%. Over long periods, U.S. inflation has averaged around 3%. That leaves roughly 7% in real returns, after inflation. That's our benchmark. Here's the formula. Your target capital equals your desired annual expenses divided by 0.07. Let's look at a real example. Say you want to spend $5,000 per month to live comfortably. That's $60,000 per year. 60,000 divided by 0.07 equals approximately $857,000. This means that if you accumulate about $857,000, and invest it in an S&P 500 index fund, such as VOO or SPY, you could withdraw $60,000 per year, and your capital should continue growing over time, keeping up with inflation. Of course, the market doesn't move in a straight line. Some years will be strong, others negative. But over the long term, 20 to 30 years, the math has historically worked. You can always choose a different withdrawal rate. If you want more certainty, you might use 4%, which would mean 60,000 divided by 0.04 equals $1.5 million. If you're comfortable with more risk and want higher spending power, 5% would require about $1.2 million. The right number depends on your risk tolerance and the age at which you plan to retire. One crucial thing to remember: this formula only works with diversification, a long-term horizon, and discipline. You should avoid withdrawing from stocks during market downturns. That's why it's wise to keep a safety buffer, cash or short-term bonds covering 2 to 3 years of expenses. That cushion allows you to ride out a bear market without selling investments at the bottom. So, grab a calculator. Add up your monthly expenses, multiply by 12, and divide by 0.07 or 0.04. The number you get is your personal target. It may seem huge, but as we'll see next, it's absolutely achievable, even if you're starting from zero today. After running the numbers, a lot of people feel discouraged. $500,000, $800,000, $1 million? Those figures sound astronomical to someone who's paying bills every month and just trying to save a little on the side. But the truth is, you're already much wealthier than you think. Your capital just exists in a different form right now. Think about this. If your employer pays you $5,000 a month today, that means they value your skills, experience, and time at that amount. You are an asset that generates income for them, and they're willing to pay for it. Using the formula from the previous section, we can make an interesting observation. To generate $5,000 per month, $60,000 per year from investments, you'd need about $857,000 in capital. In other words, your employer sees you as an asset worth nearly $1 million. You already own that capital. It just hasn't been converted into cash sitting in your bank account yet. It exists in the form of your knowledge, skills, experience, network, and ability to work. And your main task on the path to financial freedom is to convert that intangible capital into real money that works for you. How do you do that? There's only one way. Save a portion of your income. In essence, you're buying yourself back from your employer, piece by piece. If you save 10% of your salary, you're essentially creating a 13th paycheck every year. If you save 20%, that's 2 extra paychecks annually. By investing those savings into the market, the same S&P 500 we discussed earlier, you activate the power of compound growth. Within 5 to 7 years of consistent investing, you could accumulate an amount equal to your annual income. That's already a serious foundation. But the most interesting shift happens in your mindset. When you start seeing yourself as a nearly $1 million asset, you begin asking a different question. Is there someone out there willing to pay me more? Is there a company that would value my skills at $7,000 or even $10,000 a month? And the answer is almost always yes. When you earn more, you can save more, accelerating your progress toward your goal. The only real battle you'll face is the urge to spend everything you make right now. But if you can overcome that temptation, reaching your number becomes only a matter of time. So you know your number. You understand the nature of inflation. You realize you already possess intangible capital. Now comes the most important decision. How exactly are you going to reach your goal? Just like in the cult classic film The Matrix, there are 2 pills in front of you. the blue one, and the red one. Each leads to a different outcome, and the choice depends entirely on your personality, your risk tolerance, and your willingness to change your life. The blue pill, the long, conservative path. This path is for almost everyone. It's safe, predictable, and doesn't require heroic effort. Its core philosophy is simple. The process matters more than the finish line. You're not chasing quick riches. Instead, month after month, like clockwork, you invest a portion of your income into index funds, dividend stocks, or balanced portfolios. You take advantage of tax-advantaged accounts like a 401k and a Roth IRA, reinvest dividends, and let compound growth do its work. There's an interesting psychological effect along this path. When your employer senses that you're financially stable and not desperately tied to that specific job, they often begin to value you more. Raises happen, bonuses appear, better conditions are offered, simply to keep you around. You grow wealthier, yet you may not even feel the urge to quit. And that's completely normal. This is the path of steady, gradual improvement in your quality of life, where you become a little freer each year. You don't wake up a millionaire tomorrow, but in 10 to 15 years, you realize you've reached your goal almost without noticing. The red pill, the fast, aggressive path. This path isn't for everyone. It's risky, intense, and demands a complete lifestyle shift. Stepping out of the matrix of salaried employment can bring much greater rewards, but it also comes at a much higher cost. The first step is understanding what you're truly being paid for and starting to sell that directly. For example, if you're a graphic designer working in an office, realistically putting in 2 to 3 focused hours a day and spending the rest scrolling social media, freelancing could completely change your income. Platforms like Upwork and Fiverr make it possible to find clients and potentially earn 2 or 3 times more, simply by using your time more efficiently. The next level is becoming the employer, hiring other designers, building an agency, scaling the business. At that point, income doesn't just double, it can multiply. Instead of $5,000 a month, you might reach $20,000 or $30,000 or more. But there's another side to that coin. Will you actually be happy working 12-hour days, 7 days a week, carrying responsibility for employees and clients? Is it possible that after hitting your financial goal in 3 to 5 years, you'll be so burned out that you won't have the energy to enjoy it? That's a question only you can answer. One path is a marathon. The other is a high-intensity sprint with obstacles. Both can lead to financial independence. The choice is yours. After running all the numbers, the main question becomes, where do you actually get 7% per year above inflation? The good news is that in the United States, there are simple and reliable tools for this. You don't need shady schemes or secret strategies. The entire philosophy of investing is built on the long-term growth of the economy. S&P 500 index funds. The simplest tool is an ETF like VOO or SPY, which allows you to invest in 500 of the largest U.S. companies. Historically, the S&P 500 has delivered average annual returns of about 10% before inflation over long periods. Subtract the average 3% inflation rate, and you get roughly 7% real returns over long horizons, 20 to 30 years. Bonds. To reduce risk, investors add bonds, for example, an ETF like BND. Bonds offer lower returns, but they act as a shock absorber during market downturns. U.S. Treasury bonds are considered some of the safest investments in the world. The 60-40 portfolio, the classic strategy, 60% stocks and 40% bonds, was designed to target 7 to 8% average returns with significantly lower volatility than an all-stock portfolio. This is the go-to choice for many financial advisors managing retirement accounts. Tax advantages. All of this is best done inside retirement accounts, like a 401k or an IRA. These accounts allow your investments to grow tax-advantaged, meaning you avoid taxes on dividends and capital gains along the way, which dramatically accelerates wealth building. The most important rule? Don't try to outsmart the market. It's enough to buy the broad market consistently every month, reinvest dividends, and let time do the heavy lifting. There is no such thing as the perfect time to invest. There never has been, and there never will be. Look at the past few years. 2020, COVID, panic, lockdowns. It felt like the world had stopped. 2022, a bear market, rising inflation, recession fears everywhere. 2024, elections, geopolitical tension, uncertainty. Every single year comes with a reason to delay. Now isn't the time. I'll wait for things to settle down. The market is too high, or the market is too low. This is the trap millions of Americans fall into. Waiting for the perfect moment only leads to lost time. And time is the most valuable resource in investing. Time, combined with compound growth, is what builds real wealth. There's an old saying worth remembering. The best time to plant a tree was 20 years ago. The second best time is today. If someone had started investing just $200 a month into the S&P 500 20 years ago, they'd likely have well over $150,000 today. But none of us has a time machine. The only moment you can actually control is right now. Open a brokerage account. Vanguard, Fidelity, Schwab. Set up automatic contributions of 10 to 15% of your paycheck into an index fund. Max out your 401k, especially if your employer offers matching contributions. Don't wait for Monday, the first of the month, or the new year. You already know the formula. The tools are clear. The two paths are laid out. There's only one thing left to do. Take action. Tomorrow will always be later than today. Your future self will thank you for making that decision now.